I've made thousands of people profitable using fair value gaps, and I want you to be the next. Welcome to Arjo's world of fair value gaps. Now there's 7 puzzle pieces that we need to collect, and by the end, you will know every little secret about fair value gaps. Now we need to make sure we're on the same page here. So let's start with puzzle piece number 1, the different names. We have 4 different names. We have a busy, we have a sibby, we have an imbalance and a fair value gap. Now these different names all mean the same exact thing, but we'll dive into the exact meaning at piece number 3. But first we need to go over piece number 2. What does it look like? You might think I already know what a fair value gap looks like, but you don't know how we define it. And the way we define it is crucial to understand the advanced concepts later on. So a fair value gap always has 3 candles. Now let's take a look at a bullish fair value gap. The first candle can be an up candle, can be a down candle, it doesn't really matter. For this example, let's say it's an up candle. Now the second candle at all times is what I call an expansion candle because it expands higher, or in a bearish fair value gap example, it expands lower. And that body that closes above the first candle high, that's the part that can be a fair value gap once the third candle closes. And the third candle is arguably most important because it determines if we even have a fair value gap in the first place. If it trades back to the same level as the first candle high, that means there's no fair value gap. But if the third candle in its duration never trades back into the first candle high, then we have a fair value gap, and exactly inversed for a bearish fair value gap. Now that's not the only reason why this third candle is extremely important, because it also determines what type of fair value gap we are going to have. A good or a bad fair value gap. Now we'll touch on that in just a second, but first we need to move on to piece number 3, the purpose. So what is the purpose of this fair value gap and why is it important and why can we use it to trade? So remember in piece number 1, the different names that we mentioned. Now we want to understand them a little bit better. We mentioned busy and sibby, and they are opposites of each other because busy refers to a bullish fair value gap and sibby refers to a bearish fair value gap. Busy stands for buy side imbalance, sell side inefficiency. And sibby is the exact other way around. So sell side imbalance, buy side inefficiency. Now those are already some advanced words. So let's break that down one by one. So if we take the word busy and we first focus on buy side imbalance, those first 2 words, and that refers to a bullish fair value gap where the word buy side indicates that we went higher. So we bought. And the imbalance refers that something is wrong. Now, what is wrong? The market is always trying to balance itself. So when the market moves too fast towards the buy side, so higher, bullish in this case, that leaves behind is what we know a bullish fair value gap. And it's an imbalance because price moved too fast whilst going higher. And because it moved too fast, sellers didn't get a fair chance to get involved in the market. Only buyers got a chance to get involved. And that's exactly where the second part of busy comes from. Sell side inefficiency. So the sell side is inefficient because we haven't offered those sellers a fair chance to get involved yet. So this busy, this buy side imbalance, sell side inefficiency tells us we moved higher too fast. And a sibby tells us the exact same, just inversed. So a sell side imbalance, we moved lower too fast, and we have a buy side inefficiency. So buyers didn't get a fair chance to get involved, only sellers. So now we understand 2 of the 4 names, actually already 3 of the 4 names, because the third name that we had was imbalance. And now we also understand what this imbalance is. It's simply when price moves too fast towards one side of the market, it leaves behind an imbalance. And we also actually understand the last word, which is fair value gap, because we discussed this inefficiency, where one side of the market wasn't offered a fair chance to get involved. That's it. It's in the words that we're using, a fair chance. Because if we move higher too fast again, we create this bullish fair value gap where only buyers got a fair chance to get involved. So now we need to retrace back into that fair value gap to offer a fair chance to sellers to get involved. So what are we doing? We're offering fair value to the other side of the market to then continue. They all come down to the same exact thing. But a busy and a sibby is more advanced terms, where an imbalance is Very simple. For this video, we will focus on the terms fair value gap and FVG. Now, the interesting part is that we just went over how it creates this imbalance in price. So it moves too fast. So by its definition, it tells us price went too fast. In other words, it tells us the direction of price. Are you starting to see why these fair value gaps are then so powerful? Because they literally tell you what price wants to do. These fair value gaps not only tell us the direction, but also how we are going to get there. But first, let's focus on how fair value gaps tell us the direction of price. So we arrive at piece number 4, the direction. Now, the direction in price is also often referred to as a bias, because the first thing you have to determine when you open a chart is, are we going to be bullish or bearish? So how do we use fair value gaps for this? Well, we start off by focusing on the most recent fair value gaps. But before we do that, we need to understand timeframes. I use the following timeframes for my bias, and I would advise for you to do the exact same thing. The monthly, the weekly, the daily, and the 4-hour time frame. Now, you might think, and you'll see, that these time frames are quite high. And that's for a reason. Because in trading, the higher the time frame, the stronger the time frame. So that means from these 4 time frames, the monthly is the strongest time frame that we are using. So if the monthly tells us that we want to go higher and want to be bullish, then the other time frames will simply follow the monthly time frame. And that's again because it's the strongest. In Dutch, we have a saying that it's the right of the strongest. So whatever the strongest wants to do, that's what will happen. Now, I don't just want to leave it at that, because why actually is this as well? Why are these higher time frames the stronger time frames? Institutions, hedge funds, they trade with a large amount of volume, with a large amount of orders. Now, because they do this, they also move the market. And the bigger the amount of orders, the more difficult it is to get involved in the lower time frame. Because for every buyer, there needs to be a seller. And if you are trying to sell me 1,000 cars, I might not have the money for it. But if I gather a group of 1,000 other people that are also looking to buy a car, then we together might be able to buy your 1,000 cars. It's the same in the market, because on the higher time frame, there are loads of orders. On the lower time frame, not so much. So they move the market by getting involved on the higher time frame. But not only that, because we just mentioned that they move the market, and sometimes they move the markets too fast. So what happens when they place a huge order and they move the market too fast? It leaves behind a fair value gap. So those fair value gaps are the footprints that those big orders leave behind. In other words, when they move the market, they are literally creating the market essentially. They are leaving behind signs. So how easy is it for us to simply follow their footprints? Let's open a chart, but before we do that, I want to emphasize on the fact that these fair value gaps, they work on every single market. So whether it's Forex, the Indian market, the US indices, or the stocks or crypto, whatever you can think of, these fair value gaps, they work. Because it's the basic principle of how any given market operates. So when we open a chart and we're looking at Euro US dollar right here, then we first of all want to start on the monthly time frame to tell us that direction. But what do we actually pay attention to when we open a chart? Well, those fair value gaps, yes, but there's one step before that. Because we pay attention to the lags in the market. And we have lags with fair value gaps and we have lags without fair value gaps. So then what's a lag? To understand a lag, we need to understand swing highs and swing lows. Now, this is a very easy concept, because a swing high is a 3-candle pattern where the candle in the middle, so the second candle, sticks out at the top. So this candle right here is higher than the one left of it and higher than the one right of it. That means we have 3 candles right there. The middle one is sticking out at the top. And once the third one closes, so the one on the right, once that candle closes, we now have this swing high sitting right there. Now the same exact thing for a swing low. So a swing low is again that 3-candle pattern where the candle in the middle is sticking out, not at the top in this case, but at the bottom. So the candle in the middle is lower than the one to the left of it and lower than the one to the right of it. When the third candle closes, then this swing low right there is confirmed, and it's actually a swing low. Now, if we take this swing low sitting right there towards this swing high, then this is a lag from the swing low towards the swing high right there. This is a bullish lag. But if we look at this example, and when we have a swing high followed by a swing low, that's when we have a bearish lag. Now, you'll notice right here that we have a few lags for example, this one from that low towards that high with a fair value gap in the middle right there. But we also have this leg from this swing high towards that swing low with no fair value gap right here on the monthly time frame. And this is where it gets interesting, because according to my data and what I've discovered years ago is that when a leg has a fair value gap in it, it has a significantly higher percentage of actually holding. And holding meaning that it continues in the direction of the fair value gap. So it's a bullish fair value gap, a bullish leg. That means we can continue higher. Whereas legs without fair value gaps in them are a lot lower probability of holding. Now those legs with a fair value gap in them is what I and the MMT, and you might have seen it go quite big on social media as well, order flow lags. And when we open a chart and start on the monthly time frame, we always want to focus on the most recent order flow lag, because they will exactly tell us what price we'll want to do next. Now that does not mean that we only focus on order flow lags, because lags without a fair value gap in them also tells us something, right? Now because an order flow lag has a fair value gap, it tells us that we want to continue in a direction, most likely, because that's where the big orders are, following those footprints. But when we don't create that fair value gap, it tells us the exact opposite. For example, we have this lag right there continuing lower. Because it does not create that fair value gap lower, that means there are no big orders actually selling. So there's no intention, no desire to continue lower. Otherwise, it would have also created a bearish fair value gap. So when it's not an order flow lag and it's a lag without a fair value gap in it, we can confidently say as well, we in this case might actually want to continue higher. So when we continue focusing on this direction, then here we see on the monthly time frame, we have this fair value gap. In other words, we also have this order flow lag to continue higher. Now, what you want to do after that is go into the weekly and the daily and make sure they are in alignment with the monthly time frame. So the monthly right here tells us that we might want to continue higher. We want to make sure that we're then ideally as well looking for higher prices on the weekly, the daily, and the 4-hour. And when everything is in alignment, that's the best trading ID. Now, I need to emphasize on the fact as well that we don't want to use old fair value gaps. Old fair value gaps are fair value gaps that are not in the recent lag. So in this case, we have a fair value gap sitting right there, all the way below price action. This fair value gap is not part of the recent order flow lag, because the recent order flow lag is this right here. These old fair value gaps, they can be potentially used as a target. So for example, if we start disrespecting the order flow here and we want to continue lower, we can target this fair value gap. But these old fair value gaps do not tell us the overall direction of price, because the direction is told by the most recent order flow lags. But that's not all, because when we determine we have this order flow lag and we might want to continue higher in the direction, then how are we actually going to deliver higher? So what is the support or the resistance area we can continue higher or lower from? That leads us to piece number 5, the narrative. Now, the narrative, simply said, is how we are going to get there. Imagine you're in your house, wherever you are, and you want to go up a floor. Then your bias, your direction, is the intention that you want to go up. And then how are you going to get there? Well, I assume that most of us are going to use the stairs. So the stairs are the narrative. It's the method of getting there, so going higher. And you probably already guessed it, that fair value gap not only tells us the overall direction, but it also tells us the narrative. So how are we going to get there? In other words, in a bullish example, it's a support area that we can retrace back into to continue higher from. And in a bearish example, it's a resistance area that we can continue lower from. Because we understood those names of the fair value gaps, we understood it was a buy side imbalance and a sell side inefficiency. So we also need to offer sellers a fair chance to get involved. Now, because of this reason, a fair value gap is something that attracts and also rejects. So think of it like this. When you're in a hurry, you want to go out of the house, you need to get somewhere, and you forget your keys when you just went out the door. So what do you need to do? You first need to go back to grab the keys, and then you can go again. That's the same thing a fair value gap does. But a fair value gap doesn't forget its keys, it forgets to offer fair value. So this fair value gap right here that we have, it not only tells us we might want to continue higher, it also tells us that we can trade back into it right there to then reject and continue higher from it again. So when we leave behind a fair value gap and we trade back into it, so we create a retracement, we're always expecting that fair value gap to create a new fair value gap in the same direction. So what we did with this previous fair value gap right here, we saw that eventually we retraced back into it, we continued higher, and eventually created a new fair value gap from the previous fair value gap. This again overall helps us in understanding the direction. For example, right here, we have this bearish fair value gap. This bearish fair value gap never created a new bearish fair value gap. What does that tell us? That tells us that this bearish fair value gap right there is not strong enough to push price lower again. In other words, we might want to continue higher and be bullish instead. Then when we do create this retracement and we create this rejection to continue higher again, this rejection is of course what we can profit from. But let's stay with the narrative for now and understand first of all what makes a good and a bad fair value gap. Just because it looks like a fair value gap doesn't mean it's a good one. We need to understand if we can actually trade off of it. The first thing we need to make sure of is that our fair value gap is in context of other timeframes. So in a case where we need to find our direction in price and we have two fair value gaps. So we have a daily bullish fair value gap and below that we have a weekly bullish fair value gap. Which fair value gap are we most likely going to trade back into to then continue higher? In this case, we want to use the higher time frame one. So in this case, it would be the weekly fair value gap. Why? Well, that's because the fact that we mentioned the higher the time frame, the stronger the time frame. So imagine it like a magnet. Those fair value gaps are magnets and also rockets. We can attract back into it and also reject from it again. And the higher the time frame, the stronger that magnet and rocket is. So here we are on US dollar JPY and we are on the daily time frame. Now, if we take a look at the daily time frame, we see that it has this daily fair value gap sitting right there in the most recent order flow lag. So some might think, well, now we want to continue lower and we can use that fair value gap to continue lower from it. But that's not the case. This is why it's important to start on the higher time frames and then work your way down. Because if you were to take a look at the monthly first, then we see on the monthly, we have this fair value gap sitting right there. This gray box is the monthly fair value gap. This right here is the daily fair value gap. So this daily fair value gap was not in context of the monthly time frame. And since the monthly time frame is the stronger time frame because it's above the daily time frame, we are more likely to retrace back into the monthly fair value gap and then continue lower. Now this goes for every time frame. So what we're going to go over, your entries later on, also need to be in context. Now this sounds like a pain, but it's not hard and actually is very easy. Because if you just start on the highest time frame, then work your way down, you will be all right. Now later on, to make it as easy as possible for you, I will also give you the right time frames and which time frames you ideally want to use. Now this is one way to filter out good fair value gaps from bad fair value gaps. Then next, what we want to do to focus on the best fair value gaps is to only focus on the most recent order flow lag, like we've already mentioned, and also focus on the unmitigated fair value gaps. So sometimes I see people focusing on fair value gaps that have already been traded back into before. Now let me say this very clearly. A fair value gap can only be traded back into one singular time. And if it does trade back into that fair value gap a second time, it's not trading from the fair value gap, it's trading from the swing high or swing low that it left behind in the fair value gap. So for example, we have this fair value gap right there. This fair value gap has been traded into once right there, and it did not push higher initially. When this is the case, this fair value gap has now been used up. Don't focus on the fair value gap anymore to trade from it. But what we do leave behind is this swing low that was created in the fair value gap. So here we see that this swing low has now been used to continue higher from. So unmitigated fair value gaps are fair value gaps that have not been traded back into before. So for example, this right here is a fair value gap that hasn't been traded back into. So that's unmitigated. Those are the fair value gaps we want to focus on. If you don't do this, you will give up a lot of accuracy in your trading. And very simply said, if you don't do this, it contradicts the basic understanding and definition of a fair value gap. It would be the same as me placing a random line on my chart and then saying it's support or resistance. Now that might work and we might see some rejections, for example, this right here, perfect rejection from the random line I just placed, but it's not accurate because 9 out of 10 times it does not work. This is so extremely important, so do yourself a favor. Coming from someone who has mastered fair value gaps and who has made it their essentially life's work, do not, and I repeat, do not use fair value gaps that have already been traded back into. You don't need to focus on them. They're only useful to tell you what happened there. So if price continued from it or not. That leads us to the next point. For a good fair value gap, we also need to understand what have the previous fair value gaps actually done. A good sign is when we have a fair value gap and we trade back into it, that fair value gap leaves behind a new fair value gap in the same direction. For example, we have this fair value gap on the daily time frame that created a new fair value gap sitting right there. Now, this new fair value gap did not create a new bearish fair value gap. Okay, so we create a bullish fair value gap instead. This new bullish fair value gap also creates a new bullish fair value gap. That's good. When previous fair value gaps create new fair value gaps in the same direction. But you will also find the opposite, where both bullish and bearish fair value gaps are not creating new fair value gaps. Now, this is not to be ignored because this means something. This is the market telling you that we are consolidating, and a consolidation is what we want to avoid. So here we see that we have this fair value gap. We also have this fair value gap sitting right there. Then we have the bullish fair value gap and the bearish fair value gap sitting right there as well. You see that when we trade back into these fair value gaps, we don't create new fair value gaps from those fair value gaps. So what happens when this is the case for both bearish and bullish fair value gaps? That means we are in a consolidation. So when you see that happen, avoid it. In a consolidation where we're staying in the same place consistently, those fair value gaps is not something we want to trade from. We want to wait until we create a new fair value gap, and that fair value gap is holding, so creates a new fair value gap from the previous fair value gap. That's when we have good trending conditions again. Now, next is also something beautiful because we can understand where fair value gaps will actually form. So predicting where fair value gaps will form. Because fair value gaps tend to be created at previous fair value gaps and at swing highs and swing lows that haven't been traded back into before. Now, why is this? Let's say in this case that we are bearish and we are looking at lower prices. And towards the left, we see we have those old fair value gaps. Again, not fair value gaps that we necessarily want to trade from, but those fair value gaps can still create a rejection. So what we see right here is that we expand lower into the fair value gap right there. Then because of the fair value gap right here, we create a rejection to retrace back into the fair value gap that was created to then continue lower again. Now this is also seen with those swing lows. So here we have swing low right there. The same thing happens with this fair value gap right there. The reason we create the retracement is because we have a rejection from the swing low right there. Then the fair value gap is what we can continue lower from again, because those are the most recent order flow lags. Now I like to compare this to a ping pong effect, where you go down, it pings up and it pongs down again. So it goes back and forth consistently. Now when we create the reaction from those swing lows or from those fair value gaps to create a fair value gap, then how the third candle reacts right there or reject tells us what type of fair value gap we will have. Now there's 3 types of fair value gaps. And the first variant that we have is a breakaway gap. And a breakaway gap right here is where we have a fair value gap, so it looks like a normal fair value gap, but the third candle is also an expansion candle. A breakaway gap is a fair value gap that also looks like one, but we actually don't want to trade from it. And we're not expecting a retracement back into it in the short term. Now, in the scenario where we do retrace back into that breakaway gap in the short term, like this example, then oftentimes this will either lead to consolidation or opposite prices. So in this case, a bullish breakaway gap leads to small consolidation right there to then continue lower instead. So this breakaway gap essentially tells us the direction, but it's not a narrative that we want to trade from. Instead, what we want to do is when we have a breakaway gap, you want to go down time frames to find a good fair value gap. So then the question becomes, well, what do these good fair value gaps then look like? Now, before we discuss that in just a second, let's also go over the opposite of a breakaway gap, which is a rejection fair value gap. A rejection fair value gap is the opposite, where the rejection from the third candle is so big that it either fails to create a fair value gap in the first place, or it leaves behind a tiny fair value gap. So if we take a look at this fair value gap right here, then we see it's a very small fair value gap right there. And if we go back in time, the second candle, the expansion candle, before the third candle even opens, is very large. So it had the opportunity, and the potential fair value gap size could have been something like this if we did not create a retracement at all. Now this area is 100% right here, the potential fair value gap. And instead, the third candle was such an aggressive rejection that we did not even leave behind 10% of what it could have been. This tells us that it's a rejection fair value gap. And when this is the case, we want to avoid it. Why do we want to avoid it? When we want to continue higher, we obviously want a lot of bullish intention. That's why we trade also with fair value gaps. But when that third candle is such an aggressive rejection to continue lower, then that tells us as well, there's actually a lot of weakness. So a lot of bearish strength right here in the market. So in this case, what can happen? Well, you'll see that just like a breakaway gap, when we do trade back into it, we'll either consolidate or again, we'll see opposite prices. So when you have a huge rejection like this one, you want to be more careful and you want to require more confirmation in your entries. Something we're going to go over later on. Now this next one is quite advanced. It's still part of the rejection fair value gap as well, but it still continues in the same direction. So what we're seeing here on Nasdaq is that on the daily time frame, we have this potential fair value gap. Very similar to what we just saw is that we do not create that fair value gap. So we have this rejection, but instead we still continue higher. This is known as an immediate rebalance. So when we create this imbalance right here of the second candle, the expansion candle, then the first candle high right there, if we trade back into that, that will again determine if we create that fair value gap. Now what we see right here is that we trade back into it, do not create that fair value gap, but still continue higher. This immediate rebalance is signaled by having a long wick at the bottom right there in the third candle whilst trading back into the first candle high. That long wick at the bottom is something that we know as candle signs. Now candle signs, we'll dive into that in a completely different video, but that tells us that on the lower time frame right here, we still have rejections, so new fair value gaps to continue higher. When this is the case and we go down a time frame and we can still find new fair value gaps, then we can simply trade from those new fair value gaps to still continue in a direction. But then again, the question, what is a good fair value gap? A good fair value gap is in the middle. So it's not a breakaway gap, it's also not a rejection fair value gap. Now, what does that mean? The third candle is a consolidation. When relatively seen, it is a small candle or a small body. For example, right here on ES, we have this fair value gap created right there. The third candle is not an expansion, nor a big rejection. When this happens, this is a good indication that we will have a simple sting into the fair value gap to then again reject and continue higher. Now, since we want to see that third candle ideally being consolidation, you also, of course, have to be careful trading the third candles. For example, here on the monthly time frame, we just had this expansion candle right there. We are now creating the third candle right there. If this is going to be a good fair value gap, then we might see a third candle consolidation. Now, this is on the monthly time frame. So obviously and logically speaking, that's 30 daily candles. And within those daily candles, imagine how many 5-minute, 15-minute candles you have. And the reason why I say that is because if the monthly is a third candle and we're expecting a monthly consolidating third candle, then all the time frames below will be very difficult to trade and lower probability. So if we go down a time frame right here, then we can actually visually see this on the daily time frame as well, where this doesn't really go anywhere. It's a big consolidation until the month is over right there and the fair value gap has now been created. Now, the reason this consolidation happens is because the market is, you could call it lazy, or maybe a better word for lazy could be efficient, because the market is not going to go very far like a breakaway gap to then come back all the way in the future somewhere. The market will create that third candle consolidation. So in the next few candles, it has a very easy path to trade back into it to then continue without leaving anything behind. So to use the analogy again of you leaving your house or whatever it may be and you forget your keys, then it's better if you're still on your doorstep instead of already at your destination and you have to drive all the way back to then come back again. So what the market does, it forgets its keys very fast to then return in the next candle to then immediately continue again, because that's as efficient as it can be. So if you always want to trade the best fair value gap, the highest probability fair value gap, then you want to focus on the before, during, and after. So what does this mean? This is everything we've gone over thus far. Ask yourself, what is this fair value gap coming from? Is it coming from a previous fair value gap? So in this example, we have this fair value gap, and this fair value gap creates a new fair value gap. So the before phase is checked off. It's perfect. Then you move on to the during phase. So how is the third candle created right here? Is it a big rejection? Is it an expansion? Is it a consolidation? Well, right here, when we see this fair value gap, yes, it's a closure above the previous candle high right there. But is that most likely going to be a breakaway gap? No, there's also a long wick at the top right there. In my opinion, this is a perfect consolidation where the body is also a very small candle. Then this fair value gap is already a good fair value gap that we can trade from. So how do we know if the rejection from this fair value gap on the lower time frame is actually good and we can profit from it? And that's what leads us to piece number 6, the entry. First of all, you need to understand that the market is fractal. This means that whatever happens on the higher time frame also happens on the lower time frame. Now, of course, there's some nuances. Like we mentioned, the higher time frame is stronger, but the way it looks and the way it acts is the same across every time frame. Now, before we can go into the lower time frame, we need to understand two things: the target and time frame alignment. What is the target? When we want to understand the target, we need to understand the retracement that caused the move back into the fair value gap. So in this case, it is this candle right here, this previous candle, that was responsible for retracing back into the fair value gap. The retracement will either leave behind a swing low, in a bearish example, swing high in a bullish example, or in this case, there's no swing low, we can use the previous candle low. So when we retrace back into this fair value gap right there, the previous candle low right here is the main target. When we reach this target, we now stop looking for entries. This is what I call context. And what I discovered is that when you trade within this context, your trades are a lot higher probability and they have more chance of actually playing out. Now, depending on if we have a swing high or swing low, and if we have, then you use that. Otherwise, you use previous candle high or previous candle low. So next is time frame alignment. And time frame alignment is how we know which time frame to go into. So when we retrace back into this monthly fair value gap, which time frame do we want to go into to confirm the fair value gap to continue lower and look for our entry? The time frame alignment that I discovered is the following. When we talk about our normal entries, we have the following: monthly to 4 hour, weekly to 1 hour, daily to 50 minutes, 4 hour to 5 minutes, 1 hour to 1 minute, 50 minutes to 1 minute. The first time frame on the left refers to the fair value gap time frame. The time frame on the right is your entry time frame. So in this case, we're expecting this monthly fair value gap to push lower. We want to look for our entry confirmation then on the 4 hour time frame. Now, that is the normal. When we talk about sharp turn entries, which we're getting into as well, we want to see monthly to daily, weekly to 4 hour, then the daily to 1 hour, 4 hour to 15 minute, 1 hour to 5 minute, and the 15 minute still with the 1 minute as well. So if we first take a look at our normal entry and we go into the 4 hour time frame right here, then what we want to see ideally is a sharp turn. A sharp turn is the following. When we create a fair value gap on our entry time frame right here, back into the higher time frame fair value gap that we expect lower prices from, that's the first part of the sharp turn. After that, we would like to see a new fair value gap to push out of the higher time frame fair value gap. So we have the fair value gap in and the fair value gap out right there. These fair value gaps don't need to be overlapping with one another. Now that we have a fair value gap into our higher time frame fair value gap where we actually want to see lower prices, that signals that there's manipulation happening in the market. People are being manipulated right there by fast price action to potentially buy, and they think price might continue higher, where instead price actually continues lower. When this happens, this is perfect. Now, when we then retrace back into a fair value gap right there and we create a new fair value gap lower, then the fair value gaps lower right here, that is where you want to start looking for your entry. So for example, this fair value gap sitting right here. Covering, what do you cover? You cover the order flow lags high. So the order flow lag that you are actually entering from. And as a target, you simply want to look at a 2RR when you are just starting out. Now, this is a 4-hour entry. A 4-hour entry might not be what you want, but you can also go into the lower time frame of the 4-hour. We mentioned the time frame alignment, and from this 4-hour value gap, for example, you can also go into the 15 minutes or the 5 minutes if you want to. Now, if we zoom out and we go into the daily time frame, on the daily we see that we eventually have a sharp turn as well in the form of this bearish fair value gap right there. Now, there initially was no fair value gap coming back into the monthly fair value gap right there, but we did have a previous fair value gap right here, and a good sign as well is that we had an expansion candle right there coming back into the monthly fair value gap. So even though it's not a textbook sharp turn where it's a clear fair value gap in, fair value gap out, it's still a good confirmation. Because as long as we have the momentum coming in and momentum coming out again, the manipulation happens. So when we talk about sharp turn entries, the beauty of it is that sometimes you only need one fair value gap out of your higher time frame fair value gap to simply enter. So this fair value gap is enough right there. Now let's say again, you also don't want to enter from the daily. Perfect. You can, from this daily fair value gap, also look at the 1 hour or the 15 minute. So in this case, the daily and the 1 hour is closer to each other than the daily and the 15 minute. That means the closer they are to each other, the less confirmation you need. So for example, from the daily to the 1 hour, you would only need one fair value gap out of this daily fair value gap right there. So one bearish fair value gap. But on the 15 minute, you would want to see two bearish fair value gaps. So from this daily fair value gap right here, we see on the 1 hour again, we have the fair value gap in, and we also have the fair value gap out right there. When we enter from that fair value gap out, we want to cover the order flow lag high to then target a 1 to 2 RR to continue lower right there. And again, if the 1 hour is not your entry time frame or you want to go even lower, then start using these 1 hour fair value gaps to go into the 5 minute or the 1 minute. Now the entry time frame that you want to use completely is again up to you. You can confirm it as much times as you want. So you can even go into the 15 minute to then again the 1 minute. Now the thing you have to determine is if you want to use sharp turn entries and then stick to the same time frame alignment. Whether you enter with a market execution or a limit order, that depends what type of fair value gap we create. So for example, in this case, this daily fair value gap right there, that's just a normal consolidation fair value gap. So we can look to enter from that fair value gap right there and inside the fair value gap. But if we take a look at the higher fair value gap that was already created a little bit earlier right there, sitting right there, when we have a scenario like this where it's a breakaway gap, then from the breakaway gap, we can simply already enter as it's created right there, covering the previous fair value gap. Why is this? Is because we don't expect and we don't even want to see a retracement back into that breakaway gap in the first place. This is already a little bit more advanced. So first of all, I would advise just focus on those consolidation, those perfect third candle fair value gaps and only enter from those. Now, what would you do in the case of a rejection fair value gap? When we create a rejection fair value gap, you want to have more confirmation. So what does that mean? More confirmation is very simple. First of all, you determined you want to use sharp turn entries. So we had that time frame alignment. From the daily, you would go into the 1 hour, for example. All you want to do is take that baseline and go up in confirmation. So what do I mean with that? Here on the daily, we have this daily fair value gap right there. Now that daily value gap, we could argue, it's quite a big rejection right there, coming back into that daily fair value gap. So what we can do, instead of wanting a 1 hour sharp turn, which is our normal entry, our baseline, we can go above our baseline. So we can go and look for a 4 hour sharp turn. Because again, the closer the entry time frame and the narrative time frame, the better or the stronger the confirmation and the less confirmation you need. So a 4 hour sharp turn from that daily fair value gap, that can be classified as extra confirmation. So this right here could be your entry. But then the question rises, when do we go break even? Last piece of the puzzle, number 7, risk management. Risk management and going break even is very simple Because when we enter from this 4-hour fair value gap right there, or again, we want to confirm it extra by going to the 15-minute or even the 5-minute. But for this example, let's say we enter on this 4-hour fair value gap and we cover the order flow lag high, targeting a simple 1 to 2 RR. Then we want to go break even when fair value gaps are being created below our entry level. So we see right here, fair value gaps are being created below our entry level. The reason why we can then go break even is because we expect those fair value gaps, even if we do want to create a retracement, to hold and to then continue lower. So in other words, there's no reason for price to return back to our entry level. Believe it or not, but this video is only a small percentage of valuable things that we discuss inside the MMT. So if you're interested in that, take a look at arjo.io. All right, perfect. Thank you.